That gets a little more tricky because you may be coming into some unexpected money, and what's the appropriate thing to do with that? And it can depend on if you inherited a retirement account where there's specific withdrawal requirements based on the new tax laws, or if you're inheriting money from a loved one's bank account or brokerage account, or they may have stocks. There's some nuances there that you want to be cautious of.
Welcome to the Financial Foundations Podcast, your gateway to the fascinating realm of finance, brought to you by Base Wealth Management. In this show, we delve deep into the world of money, guided by seasoned experts who will unravel the complexities of finance and provide you with invaluable insights and practical advice. Now, here are your hosts, Dustin Taylor and Alex Wolfe.
Welcome back to Financial Foundations, brought to you by Base Wealth Management, where we are the foundation to your financial plan. I'm your host, Dustin Taylor.
I'm your co-host, Alex Wolfe, certified financial planner.
And today we're going to discuss how people, specifically young people, can have a healthy relationship with their money. We're going to cover everything from checking and savings to investments or retirement accounts and everything in between. So Alex, I was in the car the other day with a younger person and the topic of money came up. So now this person works a full-time job, has a 401k, which they're contributing to, which I think you would agree is great. But they also have some extra money that they put away in a savings account. And the first issue arose whenever I asked what the rate was. First of all, they said they don't know. And it made me think, like, how can we approach these type of people and get them more interested in their finances at a younger age so that they can prosper in the later years? So what would be your opinion on that situation and your experience on it? Do you agree with me?
Yeah, totally agree. And I've found here, at least in the U.S., that having money conversations can be quite taboo. You know, things that we're not comfortable or wanting to discuss with friends or family. So being in the industry, I do occasionally get friends and family that will ask me about some type of financial situation. And sometimes it's generic, some can be specific, but I think that as young adults, we were not properly educated in school unless, we took specific classes in college or university that address some of these things. So a lot of people are unaware of how to be financially, not necessarily responsible, but how to take advantage of high yield savings accounts or retirement plan contribution matches and a lot of other money topics. So yeah, this is something that I've come across.
Great. So I think where I want to start with this is like the money in the savings account. First of all, I think young people should be more vigilant in knowing what the rates are and a good going rate would be. But even before you have money in a savings account, and without getting into the weeds too much, I'd like to ask you, how much money should they have that's like absolutely liquid? Is it liquid enough in a savings account to cover a few months of rent or expenses, etc.? What's your take on that, first of all?
I would say the common practice or industry standard for financial planning advice is somewhere between 3 to 6 months of liquidity. So if you were to lose your job, you should be able to have enough in savings or an emergency fund to cover somewhere between 3 months and 6 months worth of rent, utilities, insurance, or if you have a car loan, like those essential expenses. And it could vary for some people. Like some people are more comfortable only having 3 months. Some people who are very risk averse are probably more on the 6, maybe even 9 months worth of savings to keep liquid. And I would encourage them to keep those emergency funds in some type of high yield savings account where it's FDIC insured. You're getting a decent interest rate for keeping that money liquid versus some of your large institutional banks. I won't necessarily name them all, but if you just keep that in a traditional savings or checking account like this individual, they may not be earning much of anything, even in this environment where interest rates are much higher than they were 2 years ago. So definitely shopping around for rates is important.
Yeah, I mean, as of February, I think that the rates, there's a large disparity somewhere like in your bigger bank account or maybe a smaller credit union has a very low percentage, probably like 0.5% per year, whereas something like an Apple savings account would have 4.5% currently. think they just raised the rates on that. So that's a very big difference. And I think young people really need to pay attention to that.
I definitely agree. And it's more of a big deal now than a couple of years ago when rates were much lower across the board. So it was hard to find anywhere that would pay above a 2%, even if it was considered high yield. But now the disparity between your average checking and savings account compared to some of the other institutions, that are paying much higher on that money. So definitely be vigilant. And that's not just for younger people, but anybody who's keeping money liquid in a checking or savings account.
So I think that you can agree that even if you don't have a financial advisor, whether you can or can't afford one, we'll talk about that later, I think that you can agree that at the very least, you should be putting the money in a higher yield savings account.
Correct. And there's basically no risk, as risk-free as possible. So it's not even like you're taking market risk where that principal is going to fluctuate. It just benefits you by better interest on keeping your money in a liquid savings account.
So you got your 3 to 6 months worth of expenses in a high yield savings account. That's step one. Now, step two, let's talk about the 401k. So I asked about the 401k that this person had, and they said that they were contributing to their 401k, but didn't quite remember how much. And also that they do get a match, but again, didn't know how much. So I think that's another big point, is that you need to know these details. And I remember being younger and not knowing what any of that meant, but it's important to definitely seek advice, whether that's online or through a professional, and know those details.
I definitely agree. And back to our point earlier, these are some things that we're just not educating our young people on when they enter the workforce. But to hit on some of the point about making sure you know the percentage you're contributing to your retirement account, and at least getting enough, if your company makes a match, that you're contributing enough to participate in the company matching up to typically a certain percentage of your contributions. And then comes how to invest that money that you're contributing into your retirement plan.
Right. And so I think that where it can get a little bit dicey is, and it may be a little bit too complex for most people, especially someone like me. I don't want to deal with knowing the funds and the proper allocation. And that's where you could really bring in a financial advisor. There's specific software that I know Base Wealth uses where you connect your 401k to it. And then the financial advisor, whoever that may be, can then help manage the 401k and make sure that you're in the proper funds and the allocation is correct. And then also guide you on making sure that you're not contributing too much to your 401k, to whereas you could potentially, when you retire, maybe it's not so important for young people, you can speak to that. But when you retire, that you run into like tax issues because you've contributed too much to your 401k. So when someone, a client or prospect, comes to you with a 401k and they want you to help manage it, what sort of things do you do to help?
It's not uncommon for people to come to us and a large majority of their assets be in like a 401k, especially younger people who are still in that very much of a wealth accumulation phase. And previously, it was more difficult for us to give advice and help them manage their retirement account through their employer, like a 401k. But now, as you mentioned, we have the ability to actually manage it using software. So we can be connected to their 401k and be like an authorized trader on it and help them make those investment decisions and properly allocate their money into the investments that their plan allows for. So I encourage people to work with a professional, even if you don't think that maybe you have the appropriate asset level, but it never hurts to ask. And it's easier now for us to help give advice and manage their retirement account through their 401k than it was previously.
Well, not only that, I think that what most people also don't realize is that this will help the advisor have a full picture of their whole portfolio and can really make decisions, as I kind of mentioned earlier, to avoid unnecessary taxes in retirement or other sort of issues that can arise.
Yeah, definitely agree. That was a big issue. We would only really know what was in their 401k when they would bring a statement or email us a statement for us to update that in their financial plan, where now we have full access to it and can see exactly how it's invested, how much is inside of it, what they're contributing, to be able to help them with their big picture financial plan. And also if they're able to, take advantage of doing Roth contributions inside of the plan, or if it's just traditional tax deductible contributions, we can help them, manage what they should be doing inside of that retirement plan.
We've talked about you've had your 3 to 6 months of liquid money in a high yield savings account. You are hopefully either know enough to properly contribute the correct amount to your 401k, or you've hired a financial advisor to help you. I've heard you mention the financial plan just now. When is it appropriate, like what age, I suppose, is it to have a financial plan?
That's a really good question. And when you think about financial planning, in the most common sense, it's like retirement planning, but that's such like a specific part where when you're maybe 25, 30 years old, that just seems so far in the future. You're not necessarily thinking that as like a top priority. So for someone who is younger and working full time and they're contributing to retirement accounts, but there's other goals that they're probably going to have. So working with a financial professional, they can help decide what their like short, mid, and long-term goals are and prioritize how to start saving or working toward those goals. And sometimes it may be, I'm going to be purchasing a house or a car within the next 1 to 2 years. Like, you don't necessarily want to just be putting a ton of money into the stock market if it's going to be a purchase being made in the relatively near term. So you could run into trouble if you start putting that money into the market and need to expect that to be there within the next year. If the market corrects, you may be very disappointed. So they can, as a financial professional, we can work with them to help them understand what's the best way to start saving towards their specific goals.
Okay, now let's shift into something like an inheritance or another sort of lump sum, such as a life insurance policy payout. What should people do then?
That gets a little more tricky because you may be coming into some unexpected money, and what's the appropriate thing to do with that? And it can depend on if you inherited a retirement account where there's specific withdrawal requirements based on the new tax laws, or if you're inheriting money from a loved one's bank account or brokerage account, or they may have stocks. There's some nuances there that you want to be cautious of. The first thing I want to talk about is if you inherit a retirement account and you now by law have to deplete that over 10 years. So if you inherited $10,000 or $1 million, you have 10 years to withdraw the retirement account altogether. And you want to implement like a tax strategy, possibly if it makes sense to just break it up evenly over 10 years, or if there's certain years where you have low income, take out more in those years, or less in certain years if you have more income. So that's one thing to be cautious of. Second is if you inherit like stocks from a grandparent or parent or whoever, what they get is a step up in cost basis. So if you have a grandparent that bought Apple stock in the 90s and for really, really low price, on the day that they pass away, you now get a step up where that is the new cost to you as the inheritor on the day that that person passed away. So that will help from a tax standpoint. And then it comes with like, do I keep the stock? Do I sell it? And that can vary depending on what you want to do with the money. So definitely consult with a financial professional on how to sort out working with those stocks that you inherited. A life insurance policy is going to be tax-free, so there's no tax situation there. And then you want to prioritize, like, is there any debts you want to pay off that are high interest rate credit card debt or student loans to allocate that money to? Or do you want to invest it and grow your wealth through market appreciation? So those are kind of the big things of how to prioritize and what things to think about when inheriting money.
Okay, so we've covered a variety of topics, both for younger people and the general audience. So what type of advice would you give to someone who doesn't think they have enough to work with an advisor, someone who's either maybe younger or just hasn't accumulated a whole lot in assets?
So we do get people that come in or they call us and they say, I don't think I have enough to be a client. And I think that really bugs me that they feel that they can't even come to us for advice. And yes, we work with people from all walks of life, all ages, all asset levels, and various backgrounds. And what I would tell them is it never hurts to ask, like to give them a call, say, here's my situation. Will you help me out? And we do have, as I mentioned, a variety of different types of clients and ways to help each individual person or family or small business owner out in a variety of different ways. And I think it's important to know that we are here to help you regardless of your financial situation. And even if we come across someone who we are unable to help, I would stress that we also are able to refer them to someone who might be able to help them. So it really never hurts to make a phone call to see if somebody can help you out.
All right, with that said, we have covered several things in this episode, but there's no way we can cover it all. We didn't even touch Social Security. We didn't really talk about taxes or withdrawal strategies. So if you'd like more information, visit our website at basewealthmanagement.com. There you will find articles, some market recaps every week, and also some YouTube videos featuring Alex. And if you have any other questions, feel free to reach out.
You can send your questions to us. We love audience questions to help us with new topics. You can send us to us at question@basewealthmanagement.com. And please make sure you follow us on your favorite podcast listening app.
I'm Dustin Taylor.
I'm Alex Wolfe.
And happy listening.
We hope the expertise shared by our hosts, Dustin Taylor and Alex Wolfe, has left you feeling empowered and informed. If you're eager for more financial wisdom, don't forget to subscribe, rate, and share the show with your friends, family, and colleagues. Until next time, stay sharp in the world of finance.